Hey guys, let's begin with the next part, public issue. So what exactly is a public issue? Remember in the last video I had told you that when a company needs more money, it goes public and then the shares are listed in the stock market. So how exactly are the shares listed in the stock market? The company brings in a public issue. So there is a market. The market can be divided into two parts, primary market and secondary market. Secondary market is basically the stock market. It is where you and I go and trade shares. The primary market, on the other hand, is where the company sells its shares directly to you. So the company brings in a public issue. The public issue can range anywhere between 3 to 10 days. Why 3 to 10 days? Because an investor needs time to think to invest in a company. What if the investor goes like, hey, you are asking too much money for your public issue. I do not want to invest in your company. So the company can go back and rethink about its decision and maybe lower the price and give an offer again. So that is why there is a range, because it is a big deal for the company if the public offer fails. It brings in a very bad image for the company. So the public issue can again be of two types: fresh issue and offer for sale. Offer for sale is when a promoter of the company wants to sell a chunk of his shares to the normal public. For example, recently Radhakishan Damani wanted to sell a few shares of DMart, so he brought in an offer for sale. Now, talking about fresh issue can again be of two types: initial public offer or IPO, and further public offer, FPO. So when the company is being listed for the first time, there is an IPO, but if the company is already listed and the company wants to reissue more shares and get more money, they can bring in FPO. So IPO comes only once, but FPO can come multiple times. So how exactly is the price decided? The price can be decided by two methods: fixed price method and book building method. Fixed price method is when the company goes like, hey, you want to invest in our company, you have to buy a lot, which can be of 15 shares, and per share we'll charge you 150 rupees, and the price is fixed. If you want, take it or leave it. That is fixed price method. The second method can be book building method. In book building method, the company sets a range or a price band, and there can be a floor price and a cap price. So instead of saying 150, the company says we have a range 147 to 150, and we will decide on the day of allotment. Usually the company takes the cap price. There are four categories in which people can apply to a public issue: QIB, non-institutional investor, retail individual investor, and high net worth individual investor. You and I usually fall into the category of retail individual investors, as in we apply for an IPO below 2 lakh rupees. Now, suppose you want to apply for an IPO for more than 2 lakh rupees, you can apply under non-institutional investor, NII, right? There are two more categories: the QIB, as in I had told you in the previous video that QIB are basically large or big companies like LIC, and if they want to invest into a particular IPO, they will apply under this category. And there can be high net worth individual, HNI, as in Mukesh Ambani or Rakesh Jhanjhanwala. If people with lots of money, if they want to invest in a particular IPO, they will apply through this category. If it's a book building method, they will decide a price at which they want to invest in, and usually it's the cap price. But the retail individual investor has a provision, right? The provision is cutoff price. So what happens is, if you select cutoff price, whatever price is decided, that price would be allotted to you. Now that we know about the IPO, how exactly do you pick an IPO? As in, there was IRCTC, which got listed for 300 rupees, and now it's more than 1,500 rupees. There was Ujjivan Small Finance Bank, which got listed 60% higher of its asking price. So how do you decide what IPO do you invest in so that you can get good listing gains? I will give you a checklist. First thing is that the company should have strong fundamentals. The company should have strong cash flow statement, strong balance sheet, how do you read these statements? We will look into this in the fundamental analysis module. Moving ahead, the sector. How exactly is the sector doing? For example, if it's Corona time going on, right, and the auto sector is nowhere to be seen, how exactly is the sector doing? It's again an important part. The competition. Suppose a new bank gets listed, and in the banking sector there is already HDFC, ICICI Bank, SBI, Axis Bank. There is a lot of competition. So can this new company beat them? Looks difficult, right? So competition. Promoter shareholding. So who exactly is behind this company? If Rakesh Jhunjhunwala is one of the promoters, people can go like, hey, Rakesh Jhunjhunwala is the big bull of India. If he is a promoter of some company, the company must be good, right? Next, what you gotta see is promoter's track record. So again, if it's Rakesh Jhunjhunwala had invested in companies at dirt cheap prices, right? He had invested in Titan for 3 rupees and then it went up to 1,000 rupees, right? So he has a good track record. But whereas you can take Anil Ambani, right? He doesn't really have a good track record as of now. So people can go like, okay, Anil Ambani is backing this company. This kind of looks fishy, right? So promoter track record is important again. Next is promoter share pledged. So whenever you apply for an IPO, look for this factor. Ideally, there shouldn't be any pledged shares or very low amount of pledged shares because it's not really good for the company to have pledged shares. Last but not the least, you gotta see how many mutual fund houses, how many investors, how many QIBs are interested in this particular IPO. I would also like to bring in something. I would like to tell you about ASBA, or application supported by blocked amount. What exactly is ASBA? So when you apply for an IPO, what happens is you gotta apply through ASBA. What ASBA does is it blocks that amount in your bank account. It does not debit that amount. It blocks it, and you cannot use that amount. All right. And if you are allotted the shares, then the amount gets deducted. If you're not, the amount gets unblocked. Okay. So I will give you 2 more tips for applying into an IPO. Apply on the last day of the IPO. Suppose an IPO comes in and there is a slot for 100 investors, right? So what if it gets filled up in the first day itself? So one thing that you need to know is the IPO doesn't work in a first come first serve method. It majorly works as a lottery system. So even if it is 100% subscribed on the first day, that doesn't really make a difference, right? Even if you subscribe on the first day, there are chances that you do not get allotted. So what you do is you wait till the last day. So you come to know what exactly is the demand. If there is a high demand, there is quite a good possibility that you will get good listing gains, right? So wait for the last day and check how has the IPO performed till date, and if it has done good, then definitely apply on the last day. Next, apply through as many demat accounts as possible. By this, I do not mean that you go and open 3-4 demat accounts and apply through all the demat accounts. No, because your demat account is linked by your PAN. So even if you apply 3-4 times through 3-4 demat account, there are chances that you do not get allotted because that would only be considered as one, or you are applying for many lots. What you can do is you can apply through multiple demat accounts of your friends and family. So the probability of everyone getting the shares increases, and you might end up getting the shares or the allotment. So this would be the end of this chapter, and again, I hope that you understood whatever I tried conveying you. If there are any sorts of questions you have, feel free to ask me. I'll try my best to answer all the questions you have. See you in the next video. Cheers.